such as high cost of power and energy, transport and production factors, as well as rising prices on imports. Nevertheless, the committee remains optimistic that the adopted policy stance and other ancillary measures directed at improving the agricultural and other relevant sectors of the economy will combine to restart growth and drive down prices in the short to medium term. Money market interest rates moved in tandem with the level of activity in the banking. While rates were relatively stable during the review period, the interbank core rate opened at 6.25% on January 25, 2017 and closed at 13.14% on February 28, 2017. However, the average interbank core rate rose to 100% and 133.84% on January 21 and January 23, respectively, following the withdrawal of liquidity from the banking system through the sale of foreign exchange worth 137 billion naira on February 21, 2017. Committee noted the decline in the equities segment of the capital market as the all-share index fell by 3.07% from 26,036.24 on January 21, 2017 to 25,238.01 on March 10, 2017. Similarly, market capitalization decreased by 2.68% from 8.97 to 8.73 trillion naira during the same period. Nevertheless, the end December 2016, the capital market prices fell by 3.12 and 3.063% respectively, reflecting the challenges still confronting the economy. Total foreign exchange inflows through the CBN decreased by 8.87% in February 2017 compared with the previous month, as foreign exchange market receipts were significantly lower. Total outflows also declined by 7.32% during the same period. The committee noted that the average naira exchange rate remained stable at the interbank segment of the foreign exchange market during the review period. The outlook and the risks. Available data and forecasts of key economic variables, as well as the newly released federal government's economic recovery and growth plan, indicate prospects of output recovery in 2017. The committee expects that the implementation of this plan, the new foreign exchange policy, as well as the current effort by the federal government to restore peace in the Niger Delta region, will help revive economic growth and stabilize prices. Committee identified the downside risks to this outlook to include the possibility of a slower than expected rate of global economic activity, tight monetary policy stance by the U.S. Fed, resulting in strengthening U.S. dollar and lower oil prices. The committee's considerations. Committee re-evaluated the implication for Nigeria of the continuing global uncertainties as reflected in the unfolding protectionist posture of the United States and some European economies, sustenance of the OPEC-Russian agreement to cut oil production beyond July 2017, sluggish global recovery, and the strengthening U.S. dollar. Committee also evaluated other challenges confronting the domestic economy and the opportunities for achieving price stability conducive to growth in 2017. In particular, committee also noted the persisting inflationary pressures, continuing output contraction, high unemployment rate, elevated demand pressure in the foreign exchange market, low credit to the real sector, and weakening financial system indicators, among others. Nonetheless, members welcomed the improved implementation of the foreign exchange policy that resulted in the Naira's recent appreciation. Similarly, committee expressed satisfaction on the release of the Economic Recovery and Growth Plan and urged its speedy implementation with clear timelines and deliverables. On the strength of these developments, committee felt inclined to maintain a hold on all policy parameters. Nevertheless, committee noted the arguments for tightening policy which remain strong and persuasive. These include the real policy rate which remains negative, upper reference band for inflation remains substantially breached, and elevated demand pressure in the foreign exchange market. The reality of sustained pressures on prices, here we mean consumer prices and the naira exchange rate, cannot be ignored given the bank's primary mandate of price stability. It noted that the moderation in inflation in February was due to base effects as other parameters, particularly month-on-month CPI, continued to rise. However, tightening at this time would portray the bank as being insensitive to growth expected prospects. Also, the deposit money banks may easily reprice their assets, which would undermine financial stability. Besides, the committee noted the need to create binding restrictions on growth in narrow money and structural liquidity and the imperative of macroeconomic stability to achieving price stability that is considered conducive to growth. The committee also considered the argument for loosening the stance of monetary policy, noting its desirability in stimulating aggregate demand if credit increased with lower rates of interest. It noted the argument that loose monetary policy was capable of delivering cheaper credit, making it more attractive for Nigerians to acquire assets, thus creating wealth and stimulating aggregate spending and confidence by economic agents, which would eventually lead to lower non-performing loans in the banking system. However, the counterfactual arguments against loosening was anchored on the upward trending month-on-month inflation and its impact on the exchange rate. Loosening will thus worsen the already negative real interest rate, widen the interest rate spread, and reverse the positive outlook for the current account position. On outlook for financial stability, committee noted that the banking sector was becoming less resilient as a result of the adverse macroeconomic environment. Nevertheless, the Monetary Policy Committee reiterated its resolve to continue to pursue financial system stability. To this end, committee enjoined management of the bank to work